This podcast is brought to you by True Resources, connecting talented people with the best mining employers in the Australian market. For more information, head to trueresources.com.au.
Hello, I'm Ben Kostrich, and this is the Market Bull podcast. Joining me on the show today is Matt Warder, the publisher of thecoaltrader.com, which, as the name suggests, is predominantly focused on coal, but is more so an energy, metals, and mining analyst with nearly 2 decades of experience covering pretty much everything in the natural resource and industrial sector. He's also a CEO, or the CEO, of a consultancy in financial analytics, Seawolf Research. Again, that's a bit of a mouthful, and he's a much more educated guest on the coal. So welcome, Matt.
Hey, thanks for having me. It's been a great few years to come and talk to, investors in the space about this little corner of the market that has been, heretofore largely not really paid attention to. So, happy to do it and happy to jump in wherever you like here.
Yeah, massively. The coal phenomenon, again, with the renewable energy barrage and the focus towards that, coal's always been in not the background, really should have been at the forefront. And everyone knows what we sort of use it for and how it's applied to the modern day. But before we go into that, I just want to get to know your background and your history, because we were talking before we started about really how this path or journey started for you, and now you found yourself as one of the go-to men in coal, if I may say that. Talk about your history and the journey of how you've gotten to build and sort of understand so much about this commodity.
Sure. When I started off, leaving high school and going to college, I was pretty laser focused on two things. One was, going to medical school and applying to that. And the other one, I played baseball for a year and change, in college. It helped, helped get me through a couple of years, and wound up getting hurt. And so I was majoring in chemistry at the time, and got a degree in it. And I actually picked up a degree in music as well. For me, I've always kind of sat on the cusp of, not just extrovert versus introvert, but also like, the mathematical scientific side versus the creative side. If I go and take one of the Myers-Briggs tests, I'm going to, hit the dot in the center pretty much. And that's, that kind of just characterizes sort of who I am. So I had my feet in these two very different buckets. And then when I graduated and, went and studied and crushed the MCAT and started to get into schools and, started to apply and get serious about it. I'd started a band called The Argument, and we sounded sort of like Weezer meets Queen. And we were pretty good. I mean, at the time we were still kind of very young, but, we wound up starting to get dates, and we started to get tours, and we started to travel, and, we made a record, and released it, and that got us into, a number of different clubs up and down the East Coast and across the Midwest. To finance that, we all taught. I taught in the school system. I had a private music studio, and, we did well enough to get a lot of label attention, but not quite well enough to turn the corner and make it work. Now, we all living off of it in one way or another, and we're able to pay rent or bills, and we're living in Morgantown, West Virginia, where I'm from. So the cost of living was low, and it was we were having a lot of fun. So we kinda kept
Naturally,
it going,
yeah.
but when we got to the point, about 9-10 years into the development, like we're trying to like start a business whereby we could be, content providers to the entertainment industry, whether it's in TV or, film or whatever. And there's we started to, there's a team and capital that was starting to put some people together, and looked really promising. And then it all fell through, and we kind of lost the wind out of our sail. And I remember being, in a lesson with a student of mine, and he was older and kind of, wondering about what my next step was. And, he came back in the next week and said, well, if you'd like to, I'd like to offer you a job. This is the supply study that I do on Central Appalachian coal. And I need somebody who can, is mathematically literate, who can, learn how to run models and run Excel and kind of learn this bit so that he can get freed up to do more consulting work. And so like, I wasn't even on my radar. I just wound up in, and my dad was mostly an oil and gas attorney, but he did some coal work in the early 80s, and he suggested we should give it a go and check it out, and I did, and about 3-4 months into our existence, into my career there, the little geological firm that my boss, my former student who worked for, got bought by this international consultancy, Wood Mackenzie. So in the span of about 6 months, I went from being a musician and a music teacher to a corporate energy consultant, and that was, I'd say that was a baptism by fire would be,
An understatement.
yeah, for sure. So, but when WoodMac came on board, all of a sudden you have a platform and these other people to work with all around the world who were laser focused on the same sorts of things. So you get to learn different aspects of how things are done in the rest of the world. And then for me, we were doing a study on Central Appalachia, which is where the bulk of metallurgical coal production is in the U.S. And so I got a little bit of a steel industry education as well on the side. And then, my boss moved on to the markets team. I wound up taking over most of the supply side. We worked on a team that covered all of the Americas kind of together on this one, like basically 4 or 5 of us. And, man, we had a great time. A few years later, Wood Mackenzie decided to diversify and build iron ore and steel services. And I raised my hand because that was integral to metallurgical coal production domestically. I'd be interested in doing that. So I took kind of the US and Canada and Brazil, learned how to speak Portuguese enough to function, started going to South America, and I made a lot of friends in the industry, and I just kind of, went from there. My next gig was, I wanted to move over to the equity analyst side, and I got a chance to do that and cover all mining, not just iron ore and steel, but base metals, precious metals, uranium, lithium, all that sort of stuff. And then, for the last 4 years, I've been a solo consultant over all things, but as coal has gotten more prominent, there's been there's just not much deep knowledge and expertise in the sector at all that's like publicly available. You have to go through one of the big research outlets. So, it's weird that as time has gone on, although I tried to diversify myself away from it, we've come back full circle, and now it's basically been all I've done here, which is very unusual for the course of my career.
So going in, you said as a musician and then finding yourself on the polar opposite realm, really being in equity markets and then understanding resources and commodities and particularly coal, iron ore, steel. I mean, going through that learning curve and understanding what was happening from American point of view, but also the global side of it, what were you sort of understanding as you were sort of unraveling this quite extensive economy of coal and steel and all of this? I mean, what was happening? What were you understanding and learning?
Well, I mean, the first thing that I remember, there were, it was in 2007, which was my first full year as an analyst. And there were floods in Australia that winter that sent the metallurgical coal price, right up to close to $300, if not above. Can't remember exactly. And there was this scramble to find tons around the world, and that scramble centered on my home state of West Virginia. And I remember thinking, I never grew up in West Virginia thinking we were that connected to the rest of the world. And for me, like that December was like an eye-opening experience. Like, all of these jobs and and individual businesses and service businesses that touch the coal industry down there are way more important globally than, any of us youngsters had ever really given them credit for. I mean, the workers obviously, have a vested interest in them, but it's not obvious to you unless you start to do the work.
Mm.
So like that was the first thing. And then the second thing I remember thinking was when I got to steel. So like I vertically integrated up from met coal to iron ore. Of course, you combine those two. Carbon in coke serves as a reductant for FeO2, iron ore, picks off an oxygen, and you're left with molten Fe. And that's, the first step in the steel making process is making iron. And so that kind of dovetailed in with chemistry, right? I was, kind of on the cusp of organic and inorganic. I did a little bit of polymer stuff. I did some advanced inorganic. So this was up my alley. But then you realize that steel, when you roll it into coil and then make tube and pipe, becomes an input cost for the oil and gas industry. Back then it was about 33% or so of drilling and completion costs was tube and pipe. That's probably a little bit more because steel's increased in value. Um, but steel is an input cost for oil and gas. Oil and gas is an input cost for refining. And one of the products is diesel. Diesel is an input cost for mining machinery, right? And of course, whatever you mine, if you iron ore, then you make it into steel, and the cycle starts again. And then I didn't realize it, but when you get up to that point, you sort of become a de facto macroeconomist. And the only thing that you're really missing is how does the downstream universe of consumers interact with these products that require all these raw materials? And during COVID, especially, like that was the story. We tore down all these supply chains. We had to restart them. And, you realize that it's not, this seamless machine. Like there are these individual legs that take physical amounts of manpower and time in order to get rolling again. If one of them is moving slow, the whole chain moves in slow. And then, you combine that with, policies that were being set at the time, ESG centric, that disregarded the importance of baseload energy generation, for instance, in order to replace it with intermittent solar and wind. Like at a high level, you think, well, we're burning less stuff and we have these solar and wind powers. Like it sounds like a good idea, but that's not how the grid works.
No.
I wouldn't have understood that without having to take physics and electricity and magnetism and those sorts of things. So again, I wound up in this position where I wound up with very, very broad knowledge across a number of commodities and how they fit together. And, this very deep knowledge in the kind of metallurgical coal, especially like iron ore, steel sectors that has, really served me quite well here over the past few years. That's kind of the dovetailing of the two things.
So then you said, again, over the last few years, and in particular this year, your world has been centered around coal and what's been unfolding. But this is really a product of what unfolded probably a handful of years ago. And COVID no doubtably highlighted a lot of supply chains globally. And everyone went, oh my God, this is really sort of lifted up the skirt of all of this. Talk us through what really has been evolving within the coal space and why are we seeing so much more, I guess, talk about it, or more so just the price volumes of what's unfolding.
Okay. So here in the US, there are a couple of factors. The first is coming out of the Obama administration, which was, pretty antagonistic to the industry and in my opinion, far too unapologetic about it. And again, the goal was we want to retire these coal plants and replace them with, ultimately solar and wind. But we didn't really do that. We replaced them with gas plants, which were designed to be sort of peaker plants. And now it's baseload generation. That writing was on the wall even before, Obama took over. But there's this policy is setting the demand level dynamic, okay, from the top down. Well, when you have a situation where you have forced enough supply out of the market, especially here where difficult to get a permit, you can lose leases if you don't mine on them over time. The nature of, the regulatory side is like, if you don't produce it, you lose it. And once that capacity goes away, it's very difficult for it to come back. So from top down, you can force demand down, but demand eventually becomes elastic. So when supply adjusts and demand goes back up and supply can't respond, which is what happened. The U.S. used to be the swing supplier of coal to the world, and we've limited over time the ability of the U.S. to swing. When that doesn't happen, what do you pay for that last ton available? And, the answer in 2022 was $600+ for both net and thermal coal. And that, there's a really interesting podcast that my friend Bob Brackett from AllianceBernstein did with Odd Lots. It's like July a couple of years ago. But he talked about commodity markets that are in decline. And eventually they all get to this point where they don't necessarily die down in terms of price, they die up. And then things become too expensive to maintain, which incentivizes other transitions and those sorts of things. And we're we're in the early stages of that. You know, we had during COVID when everything shut down. Now we're short in the short term on supply, not by a lot anymore. You know, it was several million tons. Now it's probably 1 or 2 million tons on the metallurgical coal side, and on the thermal coal side, mostly pretty balanced, except when demand goes particularly up. But you know, looking forward, there's really not a whole lot of new supply coming on. We're going to be balanced, you know, in the market for a little while. But when mines start running out of reserves and you don't replace them with additional tonnage, then you can see pretty clearly that unless something changes, we're going to wind up in a similar situation at some point in time in the future. And you know, steel is a complex product in that it has a lot of input costs. You know, it has labor and natural gas and iron ore and coal and shipping and coke and scrap metal and metallics and all these different things that sort of go into it. But I mean, the principal two are iron ore and coking coal. And we're in the situation where China's economic demand is not so great. Certainly not as good as it was last year. Real estate's not doing quite as good. Manufacturing's not doing quite as good. India's doing better than China, not as good as last year either. So, you know, we have but prices really can't go down because of labor inflation, because the cost of steel went up. So if you're an underground miner, like all the roof bolts are made of steel. You have all these components made of steel. Your machinery is made of steel. So when you replace it, it costs more than it did before. And so now we've just sort of ratcheted up the entire complex to a new level that is still in the process of equilibrating. We don't quite know exactly where it's going to, you know, settle out, but it's looking like somewhere, you know, on the steel side between, call it $450 to $650 per ton globally. Iron ore is, you know, eventually going to fall when these larger mines come on. You know, that price will move down to the 90s, 80s, maybe even the 60s. But coking coal is it's supported by costs. And if the price moves down to the point where supply goes away, we're going to wind up in the same situation again. And that's kind of, you know, that's not quite the situation for thermal coal, which competes with natural gas. But for metallurgical coal, it's pretty palpable that high quality material is going to be, you're going to be challenged to find it. And then there are companies that are already looking to try to mitigate that now. We'll see how that works. But it's that's sort of the dynamic that we're in at the moment.
Well, you mentioned there are a few different types of coal, and I think that's also important to break down. The umbrella term coal, that people have always got their own associations for what we use it for or how we use it for. But from what you've just been talking about there, thermal coal, met coal, and there's a few others. Can you just briefly go through, just the different aspects of what constitutes this umbrella term of coal and where we're using it for?
Sure, that's true. I mean, coal isn't one thing. It either serves as a reductant, as it does in the steelmaking process, but it also serves as a source of energy. So it heats up, you know, like charcoal does, and then serves as the reductant for iron ore in the metallurgical coal process. It smelts the iron, if you will. And then on the thermal coal side, that's for power generation. So in those instances, we burn coal to heat up a boiler, and we use the resulting steam to turn turbines and generate energy. But those boilers that we design have to use certain specifications of coal. For thermal coal, we measure it in heat content mostly. So the lower the British thermal units or BTUs, generally the lower the price, and the higher the BTUs, the higher the price. Impurities like sulfur, the higher they are, the lower the price, and vice versa. But those are the two key components. And then the other one that's trickier is ash chemistry. So when those coals heat up and start to turn into ash, they get for a brief second, they get fluid. And if the ash chemistries of different coals in the blend are liquid at the same time and they agglomerate, you can wind up with clinker, which, if anyone's ever seen the movie A Christmas Story, the dad has to go downstairs and fight the furnace because the coal that they were using for the furnace had an agglomeration and it blocked up the vent where the heat goes out. But that's the thing. So that's thermal. On met coal, it's volatile content. So a chunk of coal is made of stuff, right? Most of it is carbon. Some of it is volatile material. When you heat it, it gets driven off into the atmosphere. So the higher the volatile content, the less carbon you have, and generally the lower the price, and vice versa. That's kind of I mean, it's kind of the parameters there. You know, what's the heat content on one side versus what's the volatile content on the other side, and then sulfur is an impurity in both.
And I mean, when you're looking at I guess the thematics between the two of them, naturally on the energy front of coal, that's the part that a lot of first world countries are trying to alleviate, but then simultaneously third world countries like India and China and some of these others are actually doing the inverse. So when you're looking at that, the dynamics of what's really unfolding, you see the Western world's always talking about, no coal facilities or no coal-fired plants by a certain time, but yet other countries are almost increasing their uptick. What are you really seeing unfold in really the supply-demand curves between those? And therefore, what sort of companies are participating in this market and almost either capitalizing or restructuring to, I guess, facilitate those changes?
Okay. Well, I mean, I guess the overarching dynamic, how I would describe it is we are going through a period where, in order to mitigate climate change to some degree, and who knows how effective all of it would be, we are moving from an environment where Western countries are burning more coal to less. We're going to spend the money to transition to some sort of greener technology. We're going to decline our coal usage. That allows developing countries who need access to cheaper energy, or at least more diverse sources of energy, to burn some coal to offset that. And we're probably going to wind up meeting in the middle.
Yeah.
Eventually, I think China is probably going to try to turn the corner. And their latest plenary session just came out. They talk a lot about green initiatives in it, and they have a command economy, so they can force some things to happen. It's just we don't know exactly how it's going to work out yet for them, whether that's a successful experiment or not a successful experiment. But those are the trade-offs. Bigger countries are using less coal. Developing countries should be allowed to use more coal, but unfortunately, Western governments tend to get their nose involved in
And that
those
comes
other
back to the
people's.
regulation
Yeah,
side of things. Yeah.
exactly. So it's one of these things where the West is virtue signaling to the developing world, saying you can't do that, and the developing world is struggling to find affordable avenues to allow its people to have improved individual outcomes. I know where I stand on that on the humanitarian scale. And I like to think that is consistent with my, kind of generally liberal, sort of left of center mindset. But it is not always met with, uh, shall we say, equal enthusiasm amongst even people who are supposedly ideologically aligned with. My sort of view is I think the goals of the green transition are positive, but it's the development process that we have to, and the project management that we have to really shepherd as an analytic class. You need experts involved to figure out how quickly we can move from step 1 to step 100. And do we need to go through? Probably do need to go through steps 2 and 3 and 4 to get there. And so I think we need to set more incremental goals than we have. We kind of have these broad goals that, by 2030, it's all electric vehicles, or by 2040, there's no more coal. And that doesn't work as a day-to-day incremental goal achieving, normal.
Yeah. Well, I think I remember
normal
studying business. They'd say it's a stretch goal where you put some outlandish thing on the board and then you try and figure out the steps to get there. And it's kind of going through that motion of there's a date stuck out there, and then it's, well, what have we got to figure out to get there? But it's technically a massive scale global experiment on the shift of energy, and if we can do it, and naturally there's going to be, well, hiccups along the road. But on the met coal side of things, what's the underlying, I guess, shift? Because, steel production it's not really slowing down either, as we're seeing these emerging economies take flight, and steel is a massive component of that. So what's happening there? Is that one of those things that, companies in the coal scene are almost shifting more so to focus on that side of production to
Yep.
capitalize on growing steel? And is that really what's really unfolding as well?
Yeah, I mean, what what the what I think the market has come to the realization of is that, prices in the met coal sector, even when they're bad, and I think this year is a comparatively bad year, are okay. You know, it's not the dire uh, strait that the industry was in the last time around, which produced all these bankruptcies. It's looking like price will start to largely behave similar to how thermal coal has. Gas in the U.S. will get down to a point, and then coal stops following it because the cost structure can't handle it, and the plants that
Mm,
need the coal need the coal. So it's in the end user's best interest to keep the supply in business, and that's a market dynamic that has yet to be introduced into steel. This is it. So with that in mind, you know, I think price stability isn't the word that I want to use, but the, the relative price for met coal relative to the cost of asset, I think is going to be pretty good for at least a decade. Uh, 5 to 10 years look pretty reasonable. After that, it gets hard to project how quickly technology will be able to, pull these ideas forward, or how quickly, maybe somebody makes a huge hydrogen discovery, and, that reshapes an area of the world, that can then, inject hydrogen instead of pulverized coal.
mhm.
So, you know, for me, I mostly work as a short-term forecaster. Like, for met coal, I've looked out, for 10 years, 15 years. And, we have this, kind of tentative market balance in the next 2 or 3 years. And then we have these key shutdowns at some Australian mines. We
Mm.
have some reserves that begin to deplete in the US. And there are some projects that kind of offset it. But if everything doesn't go smoothly and Australian production doesn't recover, we're going to maintain this kind of tight balance for longer. And when anything goes wrong, it has the ability to send prices, back up into the stratosphere, into the $300, $400 range. Meanwhile, we have this cost floor that sits probably somewhere down around the $200 mark. But that's kind of those are the bookends. We could
Mm.
go a little bit above, a little bit below, without destroying supply. But, the market has to be wary of it, because we know if supply goes away, it doesn't necessarily come back.
No, it's not a split on and off sort of light switch sort of moment where it just suddenly all comes back as accessible as we expect. So looking at this, there's a wide array of countries and almost companies, I should say, that are participating in this market. I mean, when you're looking at the main players and what they've been doing, I mean, can you list some of the key companies globally, or
Mhm.
even some of the interesting ones you're seeing come online potentially? Maybe not as
Mhm.
much in the Western world, but that you're sort of quite
Mhm.
interested in because of what they're doing, or yeah,
Mhm.
just paint a picture of some of the companies that you're monitoring.
Sure. First off, let me just sort of make the broad comment that there's a lot of natural gas coming to the seaboard market, whether that's from Qatar, or the United States. So it's hard for me to look at the thermal coal market and see a whole lot of upside on pricing, absent really significant supply disruptions, which
Mm,
I don't necessarily anticipate. On the metallurgical coal side, again, we're at this sort of rough balance. But the overarching dynamic there is that China is beginning to plateau and decrease production, while India is ramping up. Uh, you know, European production is probably going to begin to go down, from on the blast furnace side. There may be some electric arc furnaces or recycling facilities that pop up online to take some of that demand. But the pace in which that happens is subjective. Countries are going to help with that, but it's probably going to go a little bit slower than people think. And the same with China. So under those blankets, I mentioned before that the tightest, sort of subcategory of coal are these really high quality, low volatile and mid volatile, coals from Australia, the United States, and Canada. And if you have that type of production, it commands a premium in the market, over the high volatile coals. There's also a spec called semi-soft, which is like it's a high vol, but a weaker coal, we'll say. And then you have pulverized coal injection, which is literally just you crush the coal up into this fine powder, and you inject that and use that carbon to reduce the iron ore as opposed to the coke, which is like charcoal, basically. Uh, so, that trifecta of products, semi-soft, you can, some thermal coals can switch back and forth. So we have a lot of that type of coal in the world. PCI, there's not a whole lot of that. Russia has most of it, and we've sanctioned that, and the prices recently to come up. But at some point in time, PCI might be replaced by hydrogen. You can inject sort of either one of them, and hydrogen can reduce iron ore as well. There are quality trade-offs to that, but PCI is something where semi-soft you can have a different type of coal. PCI you could replace with a different sort of process. But the low volatile and mid volatile, very high strength coals, premium coals, we just don't have a whole lot of. And those are the products that are going to hold their value more over time. Now, to get into the players, in Australia, that's, the BHPs and the Anglos of the world, who've recently talked about merging, and now Anglo's assets are on the block despite the recent fire at Grosvenor. We took 1.5, 3 million tons out of the market. 3 million on an annual basis, 1.5, I think, for the remainder of the year. You have companies like Whitehaven, which have moved from a thermal coal to a balanced kind of met thermal. I think they're 59-41 met to thermal now with the acquisition of Blackwater and Daunia. That's a big sea change for them. So now they're going to capture some of the upside for, metallurgical coal prices. Whereas before they were more beholden to high calorific value thermal, which is also in short supply, but under normal circumstances, not as much of an upside. Stanmore has some quality met production. Yancoal has some metallurgical coal production and a wonderful cost structure that lends themselves to these, pretty massive dividend payouts that they pay from time to time. But for me, the royalty regime in Queensland is awfully repressive at very high prices. So I think over the longer term, we'll probably get better optionality just on, a move up in coal prices from the American companies. And specifically, there are two. The first is Alpha Metallurgical Resources, which has, diversified across, low vol, a little bit of mid vol, and some quality high vol production in the U.S. They've been buying back stock like crazy over the last few years, and some of the best management and operations folks in the business. At this point, that is a more mature story, and it's going to be driven by how much free cash flow they can generate to fuel the buyback program from here on out. So they're going to mostly perform, I think, along with spot prices with some added upside just from a volatility perspective. And the other one, wearing the Alabama hat here today, is growing. So they're going to bring on a new project called Blue Creek. That's Warrior Met Coal, just ticker HCC. When Blue Creek comes on, I think from a free cash flow basis, they're going to move from about the potential of $300 to $400 million per year to closer to $8 million, I think, by the time they're all said and done with the expansion, at pretty reasonable pricing
Costs. Yeah.
Yeah. So, the double whammy of increased costs at a period in time in the market where there are some key depletions in Australia, bodes pretty well for, the fact that this stock is undervalued relative to its current price. Not all of the increase in production or, met coal exposure is quite baked in yet. I think that'll happen over time, but, probably not until we see first production at least. But those are the two horses, for better or worse, that, I'm mostly riding in the met coal space.
Interesting. And at the beginning, you talked about the downward pressure from regulators and government and the impact that has on restricting new mines coming online, really creating more monopolies in the market as the sector pretty much shrinks into major key players, and that's where it's inevitably heading with those implications. I mean, what are you seeing unfold in that regulatory space? And it's sort of hard to say that a complete change in politics, in especially with the US election, if a new group comes in and then they rewrite and completely switch policies and regulations. We're constantly in this tide of one group comes in and sets something, and then the precedent is changed with the next. Do you see
Right.
those? It's hard to say if that's going to have massive, in writing impacts on the sector, but do you see some of those fluctuations within the coal space, and what sort of potential opportunities or threats does that present from the regulations being
Right.
brought down?
Yes. So short answer, yeah, that's. I would venture to guess that's probably going to happen if we do have regime change. I mean, one of the more recent thing that's happened is a Supreme Court decision that eliminated what we called Chevron deference, which is the ability of regulators to set new guidelines based off of certain criteria and then also enforce them. So now that recommendation has to come from a party other than a government entity, and then the government has to adopt that and then begin to enforce it. The downside to that is for industries outside of coal, uh, potential you can make up whatever research that you want. Research for hire can do some really interesting things with numbers sometimes.
Hmm.
It's anybody who's done business with McKinsey probably knows that. Um, but more to the point, it eliminates the ability of EPA to set stringent standards that are maybe purposefully set so that it negatively impacts coal production. So I don't think we're going to see any of that, regardless of who's in office. If we have a move over to the Republican side, especially with the increased power demand that we have here via the build out of AI data centers, it's not out of the question that, the sun, the moon, and Jupiter could all line up and we could see another coal-fired plant built here. It'd probably be
Yeah.
replacement capacity because we are due to retire a number of different plants, but you might see a swap out or
Mhm.
stuff like that. And, that's good for some of the lower margin thermal coal regions in the US as it gives them, kind of an extended lease on life. Peabody, BTU has one of those operations in the Powder River Basin. So does Arch Resources. If that mine becomes relevant again and the margins go up, well, that's pretty material to each company's bottom line. So there are positive effects to be had that way from the demand side. Certainly with Republicans in office, the regulatory environment, is going to be looser. Will that lead to increased production? Don't really think so.
Mhm.
Seems, especially in Central Appalachia, where I'm from, aren't getting thicker; they're getting thinner. Productivity is declining, so probably not. And there are also just aren't a whole lot of projects on the horizon that could come online. So, it's probably not going to change much in the U.S. The worry that I have is, we'll drill, baby, drill, and there will be so much associated gas production that it keeps a lid on, domestic thermal coal pricing, which limits the upside for some of the coal producers. But certainly from the domestic steel side, the push to retire coke ovens or uh, you know reduce exposure to greenhouse gases of the steel side will certainly be reduced if not eliminated.
Mhm.
And maybe some of those plans change, especially if Nippon, for instance, takes over U.S. Steel, and they may want to produce more steel and export it
That shifts the
rather
whole
than.
dynamic again. Yeah.
Yeah, it does. I mean, it might, they could reopen a blast furnace and
Mhm.
that would extend, some of the coke producers' lives. It would extend, uh, you know, potentially even increase, domestic demand for met coal. So there are a lot of different directions that we can go depending on how November flips one way or the other. For the most part, I don't think it's going to change a whole lot. I think with Chevron deference out of the way, the kind of writing's on the wall. But we'll certainly have a more friendly, admin on the Republican side. It's just whether it leads to outsized performance. I'd probably lean no, not necessarily. In fact, we'd probably get better performance if we had worse policy in place. So it's it's a bit of a 6 on one, half a dozen on the other. I mean, my view is like as long as the jobs are there, and as long as the working men and women, in my home state and the other surrounding states in Appalachia are taken care of, and companies are doing a good job shepherding that. Like I'm fine either way.
Yeah. And of course, going through all of this, your expertise in the coal scene has really, well, taken flight recently, and that's part of the coal trader, writing and publishing and subscription that you've got there. Talk us through that whole package and why you have so
Sure.
much passion in really educating audiences about coal, given that I say it's probably one of the most, well, uranium used to be the most hated commodity in that demonization, and I feel coal's really said, "Oh, hold on, I'll take your spot in the sunlight." Talk us through, that sort of offering that you've got and what it
Sure.
really does for people.
Yeah, I mean, I'd venture to say that coal has always held that top spot, uh, but uranium is just a market that gathers more eyeballs, more so than anything else. Um, yeah, so the coal trader is really, I mean, the only independent, like truly independent publication out there that covers the market. It was started by my friend David Dyer, the actual coal trader. And over the years, he'd really expanded the service from being just a Substack to building a website with prices up there and price decks and earnings analysis, all this sort of stuff. The work that all of us do all the time, he had codified and put online. And then he recently got a position with Ramaco Resources, one of the domestic met coal producers, and honestly one that people should look at. There's also growing production and the right kind of coal, low vol production in central Appalachia. And from a compliance aspect, you can't necessarily do both at the same time. But I told him, well, who's gonna run it? Because you've become my primary source of news. And he said, well, you want to do it? Well, I guess I guess I sort of feel obligated to here at this point in time. It's become so important for so many people to have an avenue to have really honest discussions about market dynamics and to exchange ideas on how things might progress over the next 6 to 12 months, because I really think the next 2 years are pretty critical in the path, and there are a lot of moving parts. I mean, China's production is in decline. That's been mostly replaced by Mongolian production. There's talk now of Mongolian production maybe not replacing Chinese production, going to India. And if you soak up Indian demand, well, it's sort of like, well, how does the seaborne market play in? Is there room for, semi-soft and the types of materials that they would get from Russia and in Mongolia, in India, relative to the world? I don't know all the answers because Russia's a black box right now. Mongolia is a bit of a black box. But since both are mostly landlocked, and with Russian sanctions currently on, it's hard to see much changing until either somebody invests a whole lot of money to blow the doors
Disrupt the
off,
whole market. Yeah.
right? Or alternately, we lift sanctions and the game of trade musical chairs moves tons around the world, and tons redistribute as soon as they're permission to. So it's the next 2 years are pretty critical for that. This also happens to be at a time when the Chinese economy is incredibly weak. I don't think it'll be that way forever. I think we're probably at the bottom of the cycle right now, and you'd see it rebound probably in Q4, Q1, because that's how these cycles sort of tend to move. But my track record of predicting geopolitical events is unblemished by success. So I'm a consumer of information on that side rather than a generator of it. And I have to realize as a forecaster that I'm never going to know everything all at once. And when a key input to what my, what's important to my model changes, I have to change my mind and I have to figure that out as quickly as possible. That's something that is easier to do as an independent than it is when you're working in an organization, for instance, and you have, maybe a group who does steel or gas or something where that's already updated their view and you're operating under their parameters. It's, you can kind of, you have some independence, in those situations, but it's easier just to go, scratch that. Here's the new one. Here's what happens.
The rules have
So you
changed.
can, yeah, so you can just see what the effect is as quickly as possible, and then begin to have constructive conversations on, well, what does that mean for, what are the knock-on effects for the global market? Um, that's the part of the work that I love, is like when that happens, can you scramble and get to an answer that is defensible the quickest, and then share that with as many people as possible and see where they think you might be wrong. Um, and it's weird to say, but I love being wrong because I always learn something,
Yeah.
and that informs whatever the next leg of work that I do is going to be.
So for those that are interested in following you or contacting you, I mean, where can listeners and viewers reach out to get
Mhm.
involved and really get access to this conversation? I know you've got a following on Twitter, and we know that Cold Twitter's is a great place to be as well.
That's right.
A public
Yeah.
forum for it. But where can they go to follow you and contact you?
Right. Well, first and foremost, the website is thecoaltrader.com. We have two services. One is just a basic news feed that comes out daily when I can do it, but a couple times a week, usually, that has a little bit of highlighted news, my take on what the news means, updated prices. Very specifically for met coal right now, we have every sort of major spec and day, week, month, 6-month, quarter, and year comparisons that you can see at a glance. Hope to do that for thermal coal across the board here over the next few months. I don't have a redistribution license yet for that, but we do have kind of broad numbers and short comparisons, those sorts of things. So that's the news feed. We also have a premium newsletter service that does much deeper dive analyses on things. I run that both on the Coal Trader and on Substack.com. It's thecoaltrader.substack.com. But those are where the paid services are. And if you join one, you get access to the other one too, but a little bit of coordination in between.
Yeah,
And,
naturally. So
and
yeah. No, I mean, this has been fascinating. Again, I know brief bits about the coal umbrella term of what it really means and what's comprised in it, but I appreciate everything that you've elaborated on today. It's helped me understand it. I'm sure the same with listeners. But if there was a few key takeaways from encapsulating our entire conversation, if there are three or, I won't limit you, but a few key points that you'd think that listeners should take away from it, what would be some of those key takeaways?
or I mean, the thing, first takeaway is the bulk of the move in the sector has already happened. So now, most of the stocks are sort of cyclical in nature. So, if you don't have a position, you want to start one, make sure you're following me at MF Warder on Twitter. M as in Mary, F as in Frank, Warder, Warder. And we also have another feed at Coal Newswire. That is just basic news that'll send you links to thecoaltrader.com. Usually I'll send out a few tweets in a day that I've written up small articles on, and we'll have like a couple that are just, tidbits probably that we throw out too. But that's a good interactive tool to just follow and set alert for. And then we do have a private feed as well. That's at the Coal Trader. If you're a premium newsletter subscriber, you get access to that. When I make, personal changes to my portfolio, that's where that goes. And then we also have a Discord for premium members as well, where we can communicate more directly and those sorts of things. So there's a lot of, there's a lot of kind of bells and whistles to the different types of service, but it's really all about being able to connect with one another in as many different formats as possible, and having access to, prices and supply demand dynamics that were previously only available for subscriptions that were thousands and thousands of dollars a year, tens of thousands.
Yeah, for industry.
Yeah, exactly. So there's no reason why retail shouldn't have access to the conversation, because the conversation is something you can have in public without fear of reprisal or repercussions. And honestly, the more we're able to make people aware of, that the sector is far more innocuous, I think, that people make it out to be, that don't necessarily know anything about it. But just, we've gone from an industry that I think has been sort of, combative at the leadership level and, trying to hold on to a future, to one that has a pretty reasonably bright future from a pricing perspective. And, has sort of moved from, a redheaded stepchild to one that is ready to, really contribute to, to ongoing global development in a way that is as environmentally responsible as we can be to try to push the envelope there. And, I think it's, in the sense of the JFK quote, sort of ask not what your country can do for you, ask what you can do for your country. It's almost, there's almost a service perspective, I think, to working in the industry right now. So, it's just a pretty market attitude change, I think overall, and in a much sunnier environment to be than a few years ago. It's been a real pleasure to get back into it and get my hands dirty and get to talking to everybody in the industry again here these past few years.
Yeah, well, the full circle, as you alluded to at the beginning. So thank you so much, Matt, for taking the time to speak with me. We're a few hours apart, quite a few thousand miles apart, but that's the beauty of conversing in these conversations, is you get to do it no matter where you are. But thank you so much for taking the time to speak with me on the show today.
Oh, man, it's my pleasure. Anytime, but happy to come back on whenever.
Thanks for listening to the Marketable podcast. Please remember that the topics and stocks discussed in this podcast are not financial advice. If you enjoyed this episode, please make sure to like, share, and follow. You can follow the Marketable on all our socials and keep up to date with global market insights.